There's no getting around it. All investing involves risk, and equity investing in particular. But is investment risk really something to be frightened of? Joe Wiggins is an expert in behavioural finance. As Joe explains, it's all about how investment risk is framed.
So equities generally outstrip most asset classes over the long term. So therefore it seems slightly odd that you get a higher return for doing that. But you get that higher return because there's a behavioural risk within equities that you have to go through day-to-day volatility, you have to go through bear markets. So there's a cost involved, a greater risk involved, a behavioural risk in generating those higher returns. So whenever we make a decision that we hope to increase our returns with, we need to think about what are the costs, what are the negatives of doing this, and are we willing to bear them? There's no worse decision really than thinking, I want to generate a long-run return from equities, but then you bail out at the first sign of volatility or drawdowns because you're not behaviourally disposed to doing that. So when we make these decisions, let's understand what the negatives or the potential behavioural implications are.
In other words, it's our ability to withstand short-term volatility that gives us long-term rewards. As long as you have a globally diversified portfolio, it's very unlikely in the long run that you'll suffer a substantial loss of capital.
The best way I conceptualise investment risk is to think of it as not being about volatility or drawdowns, but about it being the chance that we fail to meet our long-run outcomes. So we've got certain objectives in the future, 10, 15, 20, 30 years in the future. What are the chances that the decisions we make now with our investments mean that we fall short of meeting those objectives? So that can reframe the decision. So we're not thinking about the short-term volatility investing in equities, but we're thinking about the chance that I won't be meeting the goals that I have for my future self in 20 or 30 years' time. So risk is about failing to meet those goals.
Volatility, corrections and bear markets can be very painful, but they're also inevitable. The secret is to stay focused when they happen on your long-term goals.
The key thing for considering poor short-term performance is what are the implications for long-run returns, for our long-run objectives. So for example, through 2022, we saw a significant rise in bond yields from incredibly low levels. And whilst that brings about short-term pain, if we reframe it and think about the long-term consequences of that, it means that we're now investing money into bonds that are offering significantly higher returns than before. So the valuations have improved and the chances of generating good returns from those bond investments over the long run have improved. So we need to think about it. Think about short-term market movements in the context of what our long-run objectives are.
In short, don't confuse risk with volatility. The real risk, if you keep reacting to volatile markets, is that you'll fail to generate the long-term returns you need.